Even if the market is calm, stock prices move up and down all the time. And one of the reasons for this is something called stock events. Stock events are company-level actions or announcements that affect the value of a stock and your investment. These are non-market factors that change things like stock price, number of shares, or the way profits are distributed. Stock prices go up and down, and most people think it's only because of the market, news, or traders. But did you know that companies themselves often create these price movements? Whether you're a beginner investor or someone who just bought your first stock, you must understand stock events. These are decisions made by companies that directly impact their share prices and your profits or losses, even if you don't do anything. Dividends, stock splits, bonus shares, buybacks. These might sound technical, but they affect when you should buy, sell, or hold. In this video, we'll break down what stock events are the most common types. You'll see how they affect your portfolio and how to use them to your advantage. Let's explore stock events together. 1. Dividend declaration. When a company earns profit, it may share a part of it with shareholders. That's called a dividend. There are two types: interim and final. Investors love dividends for passive income. Watch for two dates: the record date and ex-dividend date. Only those who hold the stock on record date get the dividend. 2. Stock split. In a stock split, the company increases the number of shares by dividing existing ones. For example, a 1-to-2 split turns one share into two. The price halves, but your investment value stays the same. This is usually done to make shares more affordable and improve liquidity. 3. Bonus shares. Bonus shares are free shares given to existing shareholders. Let's say you hold 100 shares, and the company announces a 1-to-1 bonus. You get 100 more. Again, the price adjusts, but the value of your holdings stays the same. 4. Buyback of shares. Here, the company buys back its own shares from the market. This reduces the number of shares in circulation, often increasing the earnings per share and supporting the share price. 5. Rights issue. A rights issue is when a company gives its existing shareholders the right to buy additional shares at a discounted price. This raises capital, but may dilute existing ownership if shareholders don't participate. 6. Mergers and acquisitions. When companies merge or one company acquires another, stock can be revalued, swapped, or delisted. These events can be complex and create major volatility. Let's learn, why do stock events matter? Stock events affect more than price. They influence market sentiment, company valuation, and investor strategy. Like dividends can attract long-term investors, splits and bonuses can improve affordability.
Buybacks
Often signal strong confidence from the company. Ignoring these events could mean missing key opportunities, or worse, being caught off guard. Let's see how to track and use stock events. Always check company announcements, follow earnings calendars, and use tools like Money Control, NSE/BSE websites, or stock apps to stay updated. Use the event date to plan entries, exits, or holding decisions. Understanding stock events helps you stay ahead, not surprised. As an investor, you can use this information to make smarter decisions about when to buy and sell stocks. If you want to learn more about stock events, stay tuned for our next video. And comment below if you want a separate video on how to use bonus shares or rights issues. Follow and subscribe to 'Cause Money Matters for simple, smart finance content.